This is FarFetch on the monthly chart, and it's a pretty ugly looking chart, but things just got uglier. If I scroll down to the weekly chart, we can see that prices are now at all-time lows after breaking some minor support at the $4 level. And the support level was in jeopardy of being breached when prices could not close above the weekly support resistance band at $7. So before we continue with the analysis, let's look at this article. It's coming from barchart.com. FarFetch reports sales below estimates in Q2 and lowers guidance. And I think that's what really did it. They reported a dismal forward guidance. Online luxury marketplace FarFetch missed analyst expectations, with revenue down 1.25% year over year to $572 million. FarFetch made a loss of $281 million, down from its profits of $68 million in the same quarter last year. And this more than likely has to do with interest rates moving higher, putting a squeeze on consumer wallets, and consumers needing the necessities versus discretionary items. The chairman said the following: our Q2 results show FarFetch is growing, becoming more efficient, and executing on our key strategic priorities. We have also taken decisive action to adapt to the macro environment over the last 18 months. So we're seeing over the last 18 months interest rates moving from the ones and twos in terms of interest rates to many in the world plus 5%. Inspired by the idea of anyone allowing anyone to buy clothes from landmark boutiques of cities like Paris or Milan without having to leave their couch, FarFetch is a global marketplace for luxury fashion connecting boutiques, brands, and consumers. So this works in a booming economy, but the business model, as you can see, has some issues when the economy is contracting. FarFetch revenue growth over the last 3 years has been strong, averaging 23% annually. This quarter, FarFetch reported a year-over-year revenue decline of 1.25%, missing analyst expectations. Ahead of the earnings results, analysts covering the company were projecting sales to grow 31% over the next 12 months. The pandemic fundamentally changed several consumer habits. There is a founder-led company that is massively benefiting from this shift. The business has grown astonishingly fast, with 40% plus free cash flow margins. As an online marketplace, FarFetch generates revenue growth by increasing both the number of buyers on its platform and the average order size in dollars. Over the last 2 years, FarFetch active buyers, a key performance metric for the company, grew 14% annually to 4.13 million. This is a solid growth for a consumer internet company. All right, so what are the takeaways from their Q2 results? Bar chart states the following: we struggle to find many strong positives in these results. The company missed on key metrics such as gross merchandise value, active consumers, revenue, and adjusted EBITDA. Its revenue missed by a significant margin, and growth also slowed. Looking ahead, the company lowered its full-year gross merchandise value guidance meaningfully, and also cut adjusted EBITDA guidance for the same period. Hence, you get a collapse in price. We're going to go to the daily chart, and we had this massive gap down. Now, if you're a buyer, what you should fear is that price closed near the lows on Friday. To me, that says that the sellers are still in control and that we can see more downside risk this week coming. How low can price go? Honestly, I don't know. But I like round hole psychological numbers. So Potentially price continues to fall to the $2 level. Maybe price settles down and bases for a while and attempts to move higher, trying to close that gap. We did have good retail sales in the U.S. for the month of, I believe it was June. So the consumers still have cash. However, that cash is waning. We are at record debt for household debt, car debt, credit card debt. So if I was a betting man, I would bet that there's more downside risk than price rebounding and potentially attempting to close that gap. Thanks for watching. Subscribe, please like the video.